Welcome to today's explainer. Okay, let's dive into this. We're tackling a massive dilemma today. How in the world do you navigate a totally chaotic market when real, hard-earned capital is on the line? We are unpacking the math of the unknown, from quantitative investing and probabilistic decision-making to the incredible evolution of algorithmic trading. So, ask yourself, can you truly predict the financial markets? I mean, it's the ultimate question, right? We all desperately crave absolute certainty, especially with our money. But let's be real, the future is a complete mystery. So how do the absolute smartest quants out there survive and even thrive when tomorrow is just entirely unknown?
Let's start with Act I, the chaos of the unknown.
Think back to the 2016 Brexit vote. Right before it happened, a study actually captured what traders on the floor were going through as they grappled with pure uncertainty. They basically defined it as this terrifying reality of the unknown, when you literally don't know how to react and you absolutely cannot predict where the market is going to swing. Economists call this Keynesian fundamental uncertainty. This isn't just about calculating your everyday risk. It is the raw panic of a totally unique shock where all your historical odds just fly right out the window. And when we're faced with that kind of pure, unfiltered unknown, our bounded rationality kicks in. We've got cognitive limits, Looking at these actual pre-Brexit interpretations from the trading floor, you can feel the immense underlying anxiety. When faced with a massive geopolitical shock, human brains just tend to freeze up. And what happens next? Herd behavior, driven completely by emotion. To make things even crazier, our emotions actually compound all that market chaos. It comes down to this brilliant concept called Keynes's beauty contest paradigm. See, we aren't just trying to predict the fundamental value of a market. We're actually trying to predict what everyone else is predicting. You're guessing what I'm guessing, and I'm over here guessing what you're guessing. It's like this bizarre psychological hall of mirrors, and it perfectly explains why markets can act so irrationally sometimes.
Which brings us to Act II, the probabilistic mindset.
If you want to escape that emotional hall of mirrors, you need a total mindset shift. Amateurs tend to think in absolutes. They ask, will the stock go up or down? But professionals, they think in probabilities. They say, okay, there's a 40% chance it rises, a 30% chance it stays flat, and a 30% chance it falls. Now, what's really interesting about this slide is how embracing multiple potential outcomes actually reduces your overall risk. You stop looking for a crystal ball and start playing the odds. So how do institutions actually quantify the unknown? They rely on something called expected value. Let's look at a hypothetical biotech drug. You don't just fixate on hitting that $2.5 million breakthrough. No, you weigh every single potential scenario, from hitting an absolute home run down to total failure by its exact probability. When you sum up all those weighted values, you get your true baseline. It's a beautifully systematic way to mathematically map out the unknown. And hey, even the world's most famous qualitative investor relies on this exact math. Warren Buffett himself put it perfectly. Take the probability of loss times the amount of possible loss and subtract that from the probable gain. That is literally what investing is all about. Sure, it's imperfect, but it is the absolute foundation of everything we're doing here. This leads us directly to the Babe Ruth effect. Now, Babe Ruth is arguably one of the greatest baseball players ever, right? Yet, did you know he was the career leader in strikeouts when he retired? The guy failed constantly, but his slugging percentage was the highest in history. And that's the secret. In investing, it's really not about how often you're right. It's all about how much money you make when you are right versus how much you lose when you are wrong. That asymmetric payoff, that's the whole ballgame. And this brilliantly illustrates why that asymmetry happens. Financial markets do not operate in mild states, like a normal bell curve you'd see for human height. Instead, they operate in what mathematician Benoit Mandelbrot called wild states. These wild states follow power laws. Basically, a tiny, tiny fraction of extreme outliers, just a few wildly successful investments, are going to generate the vast majority of your returns. All right, let's move into Act III. Enter the algorithms. So if the market demands constant, totally unemotional math across thousands of different scenarios, well, we humans are at a pretty severe disadvantage. I mean, we can barely read two news feeds at the same time. Algorithmic trading is the ultimate tool for scaling this probabilistic mindset. These machines execute trades in milliseconds, they literally do not feel fear or greed, and they can continuously evaluate tens of thousands of global securities at the exact same time without even breaking a sweat. That superhuman ability to multitask? That is the mathematical secret weapon of quantitative investing. It's actually formalized in Grinold and Kahn's fundamental law of active management. Basically, this formula shows that a manager's edge is multiplied by the square root of n, which is the breadth, or the sheer number of independent bets you're taking. Because quant algorithms scan the entire global equity universe, their n is absolutely massive. Their edge is purely the mind-boggling breadth of their coverage. A classic real-world application of this massive breadth is statistical arbitrage, or StatArb. It basically boils down to a two-step automated process. First up is the scoring phase. The machines assign a numeric rank to thousands of stocks based on data signals, like spotting a stock that's randomly dropped unusually low and is mathematically due for a bounce back. Second is the risk reduction phase. This is where they carefully pair long and short positions so that broad market risks just cancel each other out. It's a brilliant way to scale that probabilistic edge systematically. And to stress test these strategies, quants deploy Monte Carlo simulations. By firing off millions of potential market scenarios using random variables, these algorithms test a portfolio against every conceivable combination of luck and volatility. It effortlessly maps out the exact probabilities of future profits and drawdowns. It's basically a way of preparing for the unknown before the unknown even happens. Finally, we arrive at Act 4, the holistic future. Now, as amazing as they are, machines are not perfect. Without human context, an algorithm might lock on to completely spurious correlations, like, trying to predict the S&P 500 based on cheese sales in the Netherlands. Seriously, that's why the absolute best approach today isn't man versus machine. It's man working alongside machine. It's called holistic quant investing. You pair that massive data processing power with crucial human oversight. Humans are there to ensure the signals actually make intuitive sense, manage transaction costs, and step in during those wild, unpredictable black swan events that completely break historical patterns. So, we've seen how top quants navigate pure uncertainty by using massive algorithms to process complex probabilities. But what about us? Ask yourself, are your daily decisions driven by calculated probabilities or by unpredictable emotions? Whether you're managing a portfolio, running a startup, or just planning your life, embracing a probabilistic mindset might just be your ultimate edge in a really chaotic world. Thanks for joining me on this explainer, and I hope it leaves you eager to completely rethink how you weigh your own risks and payoff. See you next time.